Okay, let's try to make a second round of questions, and then we leave like 2 minutes for conclusion.
Ann Davidson, Harris College. I wanted to follow up on Corkett's idea about the marketization of management of liquidity. And right now it seems like we have government debt being issued on global markets. So is this the way out, or is this even more destabilizing?
Okay, a couple of fast comments. I think.
Introduce yourself.
Oh, sorry, Ron Calitri. I'm at John Jay College. I was at Glen School for a while. Okay, 2 points. First of all, I don't think there's much likelihood that of bringing down the financial system, since they can make money whether prices are going up or down. Second point is I'm kind of wondering whether or not this is a recurrence of something that happens periodically in an unforeseen kind of evolution of monopolistic competition between states. So we have Anglo-Netherlands, we have China, United States, and so on and so forth. And I think that a lot of spending goes on to expand the markets of various states that people don't really account as part of the cost of production. And then, so the third point would be that that a lot of market differentiation occurs without changes in quality. So the question would be whether there isn't underlying all of this something like a Flynn effect. I don't know if people have heard of it, a rise in IQ over a decadal time, and the skills mismatch results from an underlying intelligence increase, unfortunately now frustrated.
Well, I have a question myself, so... Okay. Well, so trying not to be too pessimistic. So we have a whole day.
Where else can you be too pessimistic? It's not enough.
Yeah, but we have a whole day to be pessimistic. I don't want to finish the first panel already at that end. So, yeah. So in any case, so I mean, we notice certain patterns in the past, and it's clear. I mean, at least there's some clarity on what they are. And for example, in the cyclical behavior, you've noticed in the past that you have, a la Goodwin, something like demand and distribution playing a role there, and technical change with the Higgs neutral patterns when an economy emerges from the recession, and then wage shares go down in the bottom of the recession, and then after a little bit they would recover when the economy starts growing again, and so on. What I'm trying to think right now is what would be the long-term trend, or at least the long-term effects of this current crisis, and how it would be different from what we observed in the past. So I guess that is very much related to the fact that in the last 20, 80 years, the real wages are not growing together with productivity and so on. But so I would like to ask specifically, since we had some important topics that were talked about here. So first of all, maybe Corkut would like to speak how a switch back to a current account surplus, or this possible switch in the balance of payments would affect this kind of and something else is also the investment or consumption-based growth, and how this has differences in distribution impacts. I'm not sure. I mean, I'm sure about the causes, but I don't know about the causality. If you have asset price bubbles driving consumption, although you don't have the real wage going up, but still consumption was kept sort of constant because of the housing prices or the net worth of households. How does that, I don't know, how this kind of growth, the quality of growth or something like that, I don't know, how does it affect distribution? And then the patterns of technical change, what would expect right now?
This question of why people aren't investing and when it changed, and that they're not investing because as soon as they do, then it's all going to just move to China. I guess I'm not sure exactly how to say it. I would look at it differently. I mean, situation in China didn't get there independently. I mean, it's kind of fitting into the whole way that capitalism is happening over the world. And I guess, I mean, I'm a big fan of Monthly Review, and where they see the change happening is sort of towards the end of the 60s, where the destruction that happened in World War II got rebuilt. Like right after World War II, the US was really the only place doing much production, and every place else was like in shambles. And then by the end of the 60s, Japan was a powerhouse, Germany was, Europe was producing in general, and this was even before there was, you know, that much, you know, industrial production happening in the third world. So I guess what they're, you know, at that point, like a lot of other things had run their course, like the Marshall Plan and automobilization and suburbanization. So basically, it was that there was too much production happening. And in my view of why there's too much production happening is because of inequality. You know, if you have the rich people having all the money, then they're going to be making all the decisions on whether to invest and where to invest. And you automatically have inequality if you have a system that's based on profits. I mean, that's the point of it. Everybody's trying to get more than the next person. So you would automatically have a very concentrated and unequal distribution, you know, of wealth and power. So I guess that's more how I see it, of why people aren't investing. And like right before this whole crisis, when, you know, at the height of this speculative fever, there were all these articles in the Wall Street Journal about trillions of dollars looking for a home, and I just will never forget the ending of one of the articles in the Wall Street Journal. That they were quoting somebody as saying, "Well, if this is what the U.S. has come to, that's really bad. None of this investment is going into real production. It's all going into mergers and acquisitions and buying back the company's own stock to bid prices up higher." You know, and stuff like that. So I would say it's more how it's set up than that, you know, as a whole, as opposed to that, you know, the poor American capitalists can't invest because China's going to take it all that way.
Okay, so let's see. Yeah, 2 minutes.